Hey everyone, welcome to our first online accounting class, and I hope you already watched the first video of our course, and that is very important for you to watch. If you haven't done so, please watch the first video as soon as possible, and when you're done, please send me the confirmation email because it is very critical and important for you to understand what we need to do moving forward of this class, and what you need to do to finish this course. Okay, so if you have any questions, problems, concerns, please post those of your concerns and questions on our discussion board in Blackboard, or you can send me an email. Okay, I will try to reply your email as soon as possible, and also I will check our discussion board twice a week in addition to our online office hours. Okay, all right, now here's my plan. I'm going to record one video for each chapter because really it's online class, and if any part of the lecture is too fast for you, you can always replay it. So I will just try to record one video for each chapter, and that way you don't have to split your day or split the chapters for 2 days watch. Okay, all right, now let's get started on the actually it's not the first chapter, it's first chapter online, it's chapter 7. Okay, so chapter 7. All right, now chapter 7 is talk about inventory and the cost of goods sold. So the primary goals of inventory management are to have enough high quality inventory available to serve customers' needs while minimizing the cost of carrying inventory, such as production, storage, obsolescence, and financing. Low quality inventory leads to customer dissatisfaction, returns, and decline in future sales. Okay, so purchasing or producing too few units can cause stock outs, the black orders. That means lost sales revenues and decreased customer satisfactions. Okay, conversely, purchasing too many units increase storage costs as well as interest costs to finance the purchases. Okay, so we have warehouse to store our inventories. If we pile up our inventory and it's not going to be sold quickly, and then we have to pay a lot more storage fees, so to speak. Okay, all right, so okay, so first move on to the first learning objective. Describe the issues in managing different types of inventory. Okay, so that's what we talked about just before. Okay, the primary goals of inventory management: provide a sufficient quality of high quality inventories and minimize the cost of carrying inventories. Okay, so basically there are two in general there are two types of inventories that we deal with. First is for merchandisers, the retailers. We have only one type of inventory, which is called merchandise inventory. Okay, merchandise inventory. And the other type is for manufacturing companies. Manufacturing companies, we are going to have three different types of inventory accounts, which are raw materials, work in process, and finished goods inventory. So basically we have three inventory accounts for manufacturing companies, but for merchandiser, the retailers, we only have one type of inventory, which is called merchandise inventories. The reason is that merchandisers, the retailers, they don't make their products. Okay, they purchase those products from their suppliers, from their suppliers and or their partners. So they don't make products. So only thing they have is the finished goods, finished goods products. The finished products they are going to sell to their customers. So they only carry one type of inventory, which is the completely finished products ready for sale to our customers. And on the other hand, manufacturing companies carry three types of inventories. Raw materials are those items required for processing into finished goods. For example, cloth for making t-shirts, or woods for making tables, or boards, things like that. and those are the raw materials, the materials we need to make products. And work in process are the items or the products in the process of being manufactured, which is not complete finished yet. Okay, so once those products in the work in process stage and they are finished, fully finished, they will be moved into finished goods warehouse physically, and in the accounting system we call it finished goods inventory. Okay, so we have 3 different types of inventories for manufacturing companies, but we only have one type of inventory for retailers, which is just inventory, or you can call it merchandise inventory. Okay, that makes sense? All right, let's move on. So explain how to report inventory and cost of goods sold. All right, so here is the balance sheet, the partial balance sheet that shows the current assets, and inventory is a current assets and reported on balance sheet under current assets section, right next to cash and cash equivalents. Remember, when we list out items on the balance sheet for assets, we list these assets in liquidity order, right? So that means how soon or how fast they can convert into cash or they can be used up. Okay, and these current assets means they will be converted into cash or used up or gone within 12 months, and inventory is the second on the list of current assets. Okay, so here we report the ending balance for each year, because this is for a year-end balance sheet. Okay, 2017 and 2016. Okay, so this is year-end. Okay, so that will be the ending balance for inventory, and we report all assets based off on one principle, which is called historical cost principle. Okay, even though you are not able to be physically engaged in online class, but I really want you to mentally engaged in class. Okay, so when I ask questions, really I want you to think of the question and what answers are to those questions, so that way you can check with yourself if you already understand or get the information or the materials we've covered in previous chapters already. All right, make sense? Okay. All right, so once those inventory purchased, they will be reported on the balance sheet under current assets section, but once those products are sold, they will be moved out of inventory account and then put on report on the income statement and becomes cost of goods sold. Remember, we record inventory on balance sheet, use the historical cost principle, which means whatever the amount of cash or money we paid for those products will be the value of those inventories we acquired, right? So then that's the cost of getting those inventory, right? When those units are sold, the cost associated with those units being sold is reported on the income statement, which is called cost of goods sold. All right, so it's under net sales, and net sales, remember how to calculate net sales: gross sales minus discounts minus returns minus allowance and all these things, we get net sales, and then minus cost of goods sold, we have one thing called gross profit, and then we minus all other selling and administrative expenses, we get our profits from operating activities, right? And then minus interest expense and minus tax expense, we have our net income or net loss, depends on if we have a positive number or negative number. Make sense? Okay. So again, if you have any questions, you can stop and replay this part. No worries about that. And this syllabus, this PowerPoint is on Blackboard in the PowerPoint slides, PPT slides folder. Okay, you can download it. You don't have to write down everything with on your notes. Okay, so but you do need to have a notes with you. Okay, to take some to take some notes. All right. So now is the cost of goods sold equation. Remember in chapter 6 we talk about periodic and perpetual inventory systems in which we have two different math equations to calculate the cost of goods sold and ending inventory. However, as we said, these two are mathematically the same. Okay, mathematically the same. It's beginning inventory plus purchase minus ending inventory equals cost of goods sold. And if we're going to calculate ending inventories, which is going to be, we're going to be using the second equation, beginning inventory plus purchase minus cost of goods sold equals ending inventory. Okay, remember the examples that we used in chapter 6, or probably so. You start with 6 eggs in your refrigerator in this month, and you know you're gonna eat a lot more, so 6 is not enough, so you purchased like 2 dozens. So then in total you have 6 plus 24, 30 eggs to eat during the month or during the period, and at the end of the day you see you have 4 left. So in total you have been consumed or ate 26 eggs. Okay, if we're going to calculate ending inventory, on the other hand, we have 6 to start with and purchase another 24. In total we have 30, and we know we keep tracking how many the number of eggs we eat during the month, which is 24, and at the end of the day we have 4 left, right? We have 4 left. Okay, so remember these two serves the same purpose in terms of calculation, but theoretically they talk about different things, right? Periodic updates, that one is we cannot check the ending inventory. We don't know how much ending inventories we should have, right? But for perpetual inventory system, because we can systematically to track the cost of goods sold or the number of units sold during a month or during a accounting period, that way we are able to know how much inventory we should have left in our inventory, in our warehouse. That way we can go in there to count our inventory at the end of the month or at the end of the accounting period to compare if the actual number of inventory left in the warehouse that match up to the theoretical balance. That makes sense? Okay, so those are the two period. Okay, so cost of goods sold equation example: a company has beginning inventory of 5 units that each cost $10, then purchases 20 units with a cost of $10 each, sells 15 units, and is left with 10 units in ending inventory. So we begin with 5 and purchase another 20 and sell 15 units. So then at the end of the day, we have 10 units left. Then how much is the cost of goods sold, right? How much is cost of goods sold? Beginning inventory, the physical unit is 5. Each unit costs $10 to acquire. So that means the beginning inventory balance is $50, which is 5 units times $10 each. So that's $50. And then we purchase the 20 units during the month, okay? And each costs $10 again. So in total, we spend $200 to acquire that 20 units. So add up, we have $250 for our inventory, right? That's inventory available for sale. Okay, inventory available for sale. And then we have 10 units left at the ending balance. So we know we have 25 available for sale, and at the end of the day we have 10 left. Then where the difference gone, right? Where the difference go, right? It's we must sell them to our customers. So then the units being sold is 15 units, and each unit costs $10, and in total is $150, which is the cost of the units has been sold, cost of goods sold, which is $150. And this number will be the one we report on the income statement under net income, and that is the number we use along with net sales to calculate gross profit. You with me? All right. If you are, thumbs up, right? Now, perpetual inventory system that we use to calculate the ending inventory, right? So beginning inventory, we have 5 purchase 20 units. Available again is 25 units. And because using perpetual inventory system, we can systematically to track the number of units we sold during the month or during the accounting period, right? So at the end of the day, we know that we have sold 15 units. So theoretically, we will have 10 units left in our inventory, and each unit costs $10. So ending inventory will be $100, and that will be the value we report on the balance sheet for inventory. Okay, that is the balance for inventory reported on balance sheet under current assets section right below cash and cash equivalent. Okay, cash and cash equivalent. If you have any questions about this calculation or the format of reporting on the financial statements, okay, post your questions in the discussion board on Blackboard. Okay, that way each one in class will see that, are able to see that, and I can answer the questions there, so that everyone can take a look at the answer. All right, or my comments. Let's moving forward. So cost of goods sold. All right, here another example. American tech company sold 3 jump drives to a customer on account, which means it's on accounts receivable, right, at a sales price of $10 each, and the company had purchased their stock of jump drives at various per unit costs of $2.50, $3 a quarter, $3 3/4, and $4.25 and $4.50 over the last few months. So what is the cost of goods sold and what is the inventory ending balance? Basically, okay, so in the previous example, we purchased all the inventories at the same price, right? The same cost. But here we have different costs for the same products, right? And this really is reflecting a real business scenarios. Okay, so companies always purchase their products from their partners, from their suppliers, and those products cost differently from time to time. So this kind of realistic situations that's going on on a day-to-day basis, right? So then, if we purchased all these drum drives from with different price from our suppliers, then how do we calculate the cost of goods sold, and how do we report, how much should we report on the balance sheet for inventory ending balance, right? So think about this. If you ever purchased gas over last year and this year, okay, you notice that the gas price going up and down at least on a weekly basis, right? Here at Saratoga Springs, the gas price, which is not really sensitive, but if you're in somewhere in the south, like in Georgia, and then their gas price is very pretty much sensitive. Okay, they change basically on a day-to-day basis. Okay, so then how do we calculate the cost of goods sold in this situation, right? Now there are 4 methods for us to use to calculate inventory cost or inventory balance and to calculate the cost of goods sold. All right, now let's walk through these 4 methods one by one. Okay, so first it is a specific identification, and the second is called first in first out. So we can call it FIFO, F-I-F-O, F-I-F-O. The first letter of these 4 words, okay, is called FIFO, not FIFO. Okay, and third one is last in first out, is called LIFO. Okay, it's called LIFO. And the last one is weighted average. Okay, so first one, specific identification, which really easy to understand. This method is used for products that is for business that is have low sales volume, but the products really have high dollars values. Okay, so for example, car dealers, especially for those luxury cars, okay, each one of them costs so much to make. Okay, and we can use a specific identification inventory method to track the cost of goods sold and inventory balance. Okay, or jewelry stores, jewelry business. Okay, these you can use a specific identification method to calculate your inventories. Okay, and if the business their sales is in high volume, for example, if we're selling groceries, then using specific identification method is not really quite desired. Okay, it's not really a good way to calculate your inventories. Okay, so then how do we use that, right? So let's look at this example. Okay, I'm gonna read these slides to you. All right, if you have any questions, again, send me an email or put that into the discussion board. Okay, so consider the following information. May 3rd, purchase 1 unit for $70, and on the 5th, purchase 1 more for $75, and the 6th, purchase 1 more for $95, and purchase 2 and sold 2 on May 8th for $125. Right? So this $125 is the selling price of the product, but these three values, $70, $75, $95 is the cost of acquiring those units, right? So if we're using specific identification method, we just individually track the cost of those units. Okay, and this method individually identifies and records the cost of each item sold as part of cost of goods sold. If the items sold were identified as the ones that cost $70 and $95, these two units, if they're identified as the ones that cost $70 and $95, the total cost of these items will be $165, right? Would be reported as cost of goods sold, and we have one more item remaining in our inventory, which is this one purchased on May 6th, and that cost that'll be the second one, right? The second unit is purchased on May 5th, and that costs $75. Okay, so the cost of remaining items, $75, will be reported as inventory. Okay, as inventory on the balance sheet at the end of the period. Okay, that makes sense? That makes sense? Okay. So we just separately identify the cost of those units sold individually, okay, and add them up to cost of goods sold, and whatever remains in our ending balance, and we add up the cost for those units to report our inventory balance, ending inventory balance. All right. Okay. Next one is FIFO, first in, first out, and what products or what business should have used a FIFO method to report their inventories. Okay, so basically the companies or business that sell perishable products like groceries, okay, or milk, all these things, okay. And if you go to Walmart or Target and you buy milk, and you see they're in the refrigerator, then there is pile up lines of on the shelves of their milk, right? And just anytime next time you go to Walmart, or not recently, right? And if you go to those grocery stores and open up those refrigerator, and you can take a look at that, the first one and the front one in that line is always the one will be expire sooner than the last one in the line. Okay, the last one in the line. You want to sell these products as quickly as possible. You don't want to stock your milk in the refrigerator, and the most recent one that put on in the front, and the earlier ones that put in the back, and then wait for them to go in bad. Right? That makes sense. So you want those things get out as soon as possible. So we use first in, first out. The first products come into your inventory will be the first one get out to be sold to the customer. So that is what FIFO, first in, first out, means. Okay, so now let's look at this. All right, another example to illustrate how to use FIFO to report the cost of goods sold and inventory balance. Okay, so for example, we are buying t-shirts. Okay, we're companies who are selling t-shirts, but we're not really making them. Okay, so first we bought three t-shirts. Well, we bought three t-shirts, and each one cost $15. And second batch, we purchased 4 in that batch, and each one cost $20. Okay, and the last batch we purchased 3 units, and then each one is cost $26. Okay, hopefully you can see this very clear. Okay, you can see this easily. All right, so if we're using FIFO method, okay, and a customer come in, if we're using FIFO method, okay, I bought 3, then I will take out the 3 t-shirts that I bought in the first place and sell it to our customer. Okay, so now how much is our cost of goods sold? How much is our cost of goods sold? The cost of goods sold, which the cost of the 3 shirts sold, are 15 plus 15 plus 15, which is $45, right? $45. And how much is our ending inventory balance that we should report on the balance sheet? Will be 20 plus 20 plus 20 plus 20, $80 plus that's 70, no, 88. Okay, 88. So $168 will be the sum of the cost for these 7 shirts, will be the ending balance of inventory we report on balance sheet, right? For inventory, which is 168. Okay, all right. And next one is LIFO, last in first out. Okay, last in first out is the most recent one we purchased will be the first one that sold to be sold to our customer. Okay, LIFO method. Okay, so what industry in general use LIFO method? The coal mining business. Okay, the coal mining industry, they in general use LIFO method, and the reason is that the cost will be going up. Okay, the cost will be going up, and you have to consider inflation factors in there, so you always want the last one go out. Okay, you always want the last one go out first. All right, so LIFO, how do we use that? Again, the shirts example. Okay, first we purchased 3 units, each cost is $15 each, and second we purchased 20 of 4 for $20 each, and last we purchased 3 units and cost $26 each. Okay, when a customer comes in, okay, they purchased 3 units of t-shirts, and I'm going to sell these 3 units to our customer. Okay, which the very last one come in our inventory will be the very first one to be sold. Make sense? Okay, so now the cost of goods sold becomes 26 plus 26 plus 26, which is 26 times 3 will be $78. Okay, excuse my calculation for the previous slide, it's not correct. Okay, I just did the math in my mind. Okay, which is not accurate. Okay, 26 times 3, $78. Okay, and then you add each of these costs up for this 7 shirts. That will be the ending inventory balance for this inventory reported on the balance sheet under current asset section, right? So that is FIFO. And then last one is weighted average. So weighted average basically is used for oil industry or agriculture industry. Okay, because which pretty much is products is very same, and then the price doesn't really change dramatically. Okay, so that's we use weighted average methods. Okay, and sometimes which methods the company use depends not only about their industry nature, also about what stage their company is in terms of the business cycle, and also depends on the geographical location that the company is based in. Okay, so for example, if you're a company in Europe who is using IFRS, International Financial Standard Report, IFRS, International Financial Reporting Standards, okay, then LIFO is not allowed. Doesn't matter if you're coal mining industry or some other industries, LIFO is not allowed. Okay, and okay, so weighted average. Now, how do we do weighted average? Okay, so by the name, weighted average means you sum them up and divide it by the number of units you have in the inventory and get average cost for each one of units in your inventory, right? So again, we have this 3 purchase batch of inventory. Okay, and then what we do is we will add the cost of each units up, and the total cost for this 10 shirts is $203, right? And we divide it by these 10 shirts. Okay, so the average cost for each one of these 10 shirts sitting in our inventory is $20.30. So now the customer comes in and they said, hey, I want to buy 3 shirts. Okay, and they got, it doesn't matter which shirts you sell to the customer. Okay, each one of them is going to cost $20.30. Okay, so now the cost of goods sold is that plus that plus that is $60.90. Okay, $60.90. That would be our cost of goods sold. And then for the rest of these shirts, the cost times 7. The per unit cost times 7, and then we have what is called inventory ending balance reported on the balance sheet. That makes sense? Okay. All right. So summary. So FIFO method, cost of goods sold reported on the income statement. So you always report the oldest cost, right? The oldest cost. Okay. The oldest cost. Okay, and then the inventory balance will always be the newest cost. So the difference here is the oldest cost is the first one you purchased will be the first one you sell to your customer, and the most recent one that you purchased will be the one you hold in your inventory. So the cost associated with the early ones you bought will be the oldest cost, right? And then the recent bought inventory, the cost associated with those units inventory will be the cost you reported on balance sheet as inventory, so that will be the newest cost. And on the other hand, LIFO, which we do complete the opposite, right? Complete the opposite. So then the most recent one you purchase will be sold to the customers immediately. Okay, I mean at least in the first place. Okay, then the cost associated with those units will be reported as cost of goods sold on the income statement, and the early ones you bought will be sit in your inventory and will be reported as ending inventory balance. Okay, but for weighted average, whenever you got your purchase, and then you're going to calculate your weighted average cost for inventory. So it doesn't matter if which units you sell, then the cost is always going to be the average cost for each unit, and which times units you sold times the units you have in your inventory is going to add up to your cost of goods sold and ending balance for inventory. All right, make sense? Okay. Okay, so now let's look at this example. Okay, basically it's the calculation. We're gonna walk through LIFO, FIFO, and weighted average method one more time. Okay, so in this example, beginning inventory is 10 units, each cost $7, and purchase 30 units on the third, and each one costs $8. Total is $200. And on the fifth, we made another purchase. It's 10 units for $10 each. In total is $100 costs. And the sales, on 6, we sell 35 units. Okay, so and we have 15 units left in our ending balance, assuming this is the only operating activities we have in terms of this company, right? So how much should we calculate, should we use for cost of goods sold, and how much should we use for reporting inventory balance, right? It depends on the method we use, all right? So first one, if we're using the FIFO method, first in, first out, right? We purchased, we have 10 units to start with and purchase 30 units and another 10 units, okay? So that'll be the cost for each activity. Okay, so cost of goods available for sale is $410. You add these numbers up, will be the total cost for this 50 units. Okay, and if we're using FIFO method, first in will be the first one to be sold, right? So now ending inventory we have 15 units. So 15 units should come from the most recent purchase, which is 10 units to purchased on the 5th, and we have another 5 units short, right? And that 5 units should come from the second purchase. I mean the first purchase during the month, okay? So that'll be $100 plus 5 times 8 is $40, okay? That'll be $140 for ending inventory, and cost of goods sold is $270. Okay. All right. So I've gave you another way to calculate this. Okay. So let's say, okay, not really good. Give me just 1 second. Okay, bear with me because I'm using some, fancy technologies here. All right. Whiteboard. Okay, now let's say we have beginning inventory 10 units and the total is $7 each, and in total it's $70, and purchase 30 units and each is $8, and in total is $250, and another purchase of 10 units and then each cost $10, and that's $100. Okay, so cost of goods available for sale $410. Okay, now since we are using FIFO method, okay, FIFO method, we know from our calculation, oh, we have ending inventory of 15, right? Ending inventory, we have 15 units. Okay, we have 15 units. All right, so from the calculation we know we have 10 units to begin with, and plus purchase, which is this 40 units. We have 50 units available for sale, and minus the ending inventory, we in total have sold 25 units. If we are using FIFO method, that 25 units first has to be that 10 units we sell, right? So the 10 units we sell, will be 10 out of 25 units that we sold has to come from the beginning balance, okay, the beginning balance, and each one of these 10 units costs $7, so that'll be $70, right? And next, so then the difference between 25 and 10 will be 15 units, and that 15 units will be coming from the first purchase during the month, right? So the first purchase during the month, then we will have 15 units sold, and actually 35 units. Okay, forgive my math. Excuse my math. Okay, sorry to confuse you. And that 25 units left. Okay, 25 units left. That 25 units left will come from this 30 units we purchased on the 5th. Okay, so times each cost $8. Okay, that'll be $200 in total. So now we add these up. That will be our cost of goods sold, which is $270, right? So since we have cost of goods available for sale for $410, okay, then the ending will be 410 minus cost of goods sold of $270, which is $140. And that $140 is the ending inventory we report on the balance sheet. Okay, you with me? All right, so now go back to here, the PowerPoints. You see how we calculate that cost of goods sold, $270. If not, definitely rewatch this part or post your questions on the discussion board. Okay, now let's move to LIFO method. Okay, so LIFO method means that we're going to sell the products that we purchased the most recently. Okay, again, we have these beginning balance units and the purchased units. Okay, and of course, cost of goods available for sale is $410 as well. Okay, and inventory, see the balance, it changed. Okay, because we're using LIFO method. Okay, we're using LIFO method. We sold 35 units. We've sold, is that 35 units? Yeah, we sold 35 units. Okay, and 10 units should come from the most recent purchase. That 10 units, and then we have another 25 units that which comes from the first purchase. You're with me? Okay, so that any inventory will be 10 units from the beginning balance and 5 units from the first purchase. Okay, so 70 plus 40, 110. Okay, cost of goods sold will be 300. Okay, so now let's look at this one more time on the blackboard. Okay, not your blackboard, my writing tools here. Okay, one more time. Okay, so now we have we have beginning units, 10 units. We have purchased 30 units from the 2nd of October, and then another purchase of 10 units. Okay, and 410 unit cost available for sale, and any inventory still we have 15 units. Okay, well, it doesn't matter which method you use, it doesn't change the physical units you sold and you have in your ending inventory, right? It's just a different way to calculate that, which makes the cost of goods sold and any inventory balance different, right? So if we're using LIFO method, okay, last in, first out. Okay, so then we know we have 50 units purchased and minus the ending. Let me use a different color. Okay, LIFO methods, we have 50 units available for sale, and we minus 15 units in the ending balance. We sold 35 units, right? If we use LIFO method, that means the very last purchase will be the first to be sold. Okay, then out of this 35 units, 10 will be coming from the most recent purchase. Okay, so we'll sell 10 units from this purchase. Okay, each one costs $10. that will be total $100. And then 35 minus 10 units, we have another 25 units sold, which comes from the first purchase, okay? So 25 out of that first purchase of 30 units, each one cost $8. That'll be how much? $200. So you add these two up, it's $300, which is our cost of goods sold, right? And how many units left in the inventory? 15 units, and that 15 units has not been sold yet. It include 10 units from the beginning balance, which cost $7 each, and then another 5 units has not been sold from the first purchase. That makes sense? So that 5 units times $8 each, that will be $40. Okay, so in total the ending balance will be 110. The ending inventory, which we report on the balance sheet, and this one will be on the income statement. All right, again, questions post on discussion board or email me. Okay, all right, now let's move on to weighted average method. Okay, weighted average method, we have this 410 in total, and then we divide it by 50 units, right? That we in total have. Okay, so each one is going to cost $8.20, and we sold 35 units times $8.20, so that will be the cost of goods sold, and 15 units left in the ending balance times $8.20, that will be $123 for our ending inventory for balance, for inventory. Okay, all right, make sense? All right, now here's the question. Okay, you can pause your video and to think about this question. So inventory costing method, if you are those tech companies, okay, Canon, Microsoft, Apple, or Dell or Google, if you are those tech companies, what inventory method do you think they should have used? Okay, do you think they should use? Okay, do they should use, or let's say rephrase this, do you think FIFO method or LIFO method or weighted average method, that'll be a better fit for the company in terms of their company or in terms of their natures? Okay, so you can pause the video and to think about these problems. Okay, all right, now the answer is they're pretty much going to use FIFO method, and the reason is this: as we move forward, they're gonna have more advanced technologies, more advanced softwares, or more advanced machineries to produce those their products, and then the cost will going down, right? The cost will going down. So they want to match their historical cost with their revenues. Okay, they want to match their cost with their revenues. So they want their the oldest product gets to be sold quickly, or as quickly as possible, right? So they don't want hold let's say iPhone 4 up until now, and to get them on the market next year. You get you see what I'm saying? Okay, all right, so they want to sell those products as quickly as possible. So first in, first out will be a better fit for these companies. Okay, all right, financial statement effects. Okay, so financial statement effects basically is how the use of FIFO, LIFO, weighted average will affect our net income, and in turn, and then it's how does that affect our tax expense. Okay, how does that affect our tax expense? Okay, so now let's look at this inventory, income statement. Okay, we have sales minus cost of goods sold, we have gross profit, and minus operating expenses. We have income from operations, and then minus other, if we have other revenues or other expenses, add or subtracted here, then income before income tax expense, and income tax expense, which is calculated based on the income before income tax expense. Okay, and then subtract the income tax from that number. Then we have net income, right? Net income. So depends on the method we use, okay, we're going to have different numbers for cost of goods sold. Okay, we're going to have different numbers of cost of goods sold. However, we're going to have the same value for sales. We're going to have the same value for sales. No matter what method you use to calculate an inventory value, the selling price will always the same for these three different types of methods, right? It doesn't change your calculation for sales. So you're going to have the same sales numbers. But since we have different value for cost of goods sold, then accordingly, holding everything else constant, we're going to have the different income before income tax expense, which is very crucial in terms of calculating income tax expense and calculating net income, right? So in general, when we use FIFO method, the cost will be lower. Okay, the cost will be lower, and using FIFO, the cost will be higher. Okay, given the inflation factors, the cost will going up from year to year. Okay, just in general. Okay, we are learning the basics. Okay, so just in general, and a weighted average, because we weight the lowest cost and the highest cost together, so weighted average cost should be somewhere in the middle between FIFO and LIFO. Okay, so then because FIFO gave us the lowest cost of goods sold with the same sales value, then ideally it's going to give us the highest income before income tax expense. Okay, comparing to LIFO and weighted average, that FIFO will give us the highest income before income tax expense, right? So accordingly, we'll be paying the most, we're paying the highest tax if we're using FIFO method. Okay, we're paying the highest tax expense. Okay, and LIFO will have the least income before income tax expense, which will pay the least income tax, which will give us the least net income. Okay, the net income, and the effect on the balance sheet inventory. Okay, then they'll be taking the opposite, right? Be taking the opposite. If the cost of goods sold under FIFO method is the lowest, then you have the same amount of in total for inventory for your products. You calculate for least for cost of goods sold, you're gonna have a highest value for your inventory. Okay, you have the highest cost of goods sold using LIFO, you're gonna have the lowest for your inventory balance. Okay, and weighted average, again, it will be in the middle between FIFO and LIFO. Okay, so that'll be the effect, the financial statement effect of using different methods of inventory calculation. Okay. All right, so then here, if we're seeing the unit product cost increasing, okay, so that means tomorrow's unit cost of my product will be higher than the cost of that today. Okay, so using FIFO method, we're gonna have a higher ending inventory balance than we use weighted average, then we use LIFO method. Okay, then we use LIFO method, holding other factors constant. Okay, then taking the opposite, we're gonna have the lowest cost of goods sold with FIFO method, and we're gonna have the highest cost of goods sold if we're using LIFO method, right? So tomorrow the future cost will be higher than today's cost. Okay, that means the higher cost will be reported as cost of goods sold if we're using LIFO method. Then the higher cost will be reported on the income statement using LIFO method compared to FIFO method, right? So if I'm going too fast, and pause it or replay this, okay? And then on the other hand, if we're seeing unit cost declining over time, okay, in the future, then we'll have the opposite effect. We'll be having the opposite effect because in terms of ending inventory, if we're using FIFO method, okay, the most recent purchase will have the lowest cost, and the oldest purchase or the early purchase will have the highest cost. If we're using FIFO method, the highest cost will be taken out to report as cost of goods sold. The lowest value will be retained in the inventory report for ending inventory, right? So then they'll be having the lowest balance for inventory if with FIFO method, and we'll have the highest cost of goods sold with FIFO method. And LIFO will have the highest for ending inventory and the lowest value for cost of goods sold. Okay? All right. Again, these tax implications and cash flow effects, basically you're going to pay more taxes if you're using FIFO in general, okay? And tax expenses, why it's called cash flow effects? Because those tax expenses are really cash expense. Really, you need to pay these tax expense using cash, okay? It's out of pocket expense, real expense, not accrual expense, okay? They are real cash expense. You report $45 tax expense, you have to literally pay $45 cash to IRS, okay? To IRS. It's not something called a payable or some accrual expenses, okay? You can tweak on your accounting books, but no, not for tax expense. Those are real expense, okay? Real cash expense. If you're paying more taxes, then accordingly you're gonna have a lower cash balance, which means you have less available cash to use for something else. For example, if you are going to invest in some new projects, simply because you're paying more taxes, you're short on cash, you're not able to initiate the new projects, which probably in the future will hinge the company's competitive position in the market, or in terms of or comparing to your competitors, so to speak. That makes sense? All right. Now, okay guys, it's enough for talking. So now let's do some exercise, okay? In-class practice, so-called in-class practice. Okay, here's the thing about accounting class, especially it's online accounting class. Okay, only by watching me doing all these practice problems doesn't really help you to understand these concepts, okay, the materials. It's really not that way you can get those knowledge intuitively. So you have to work with me on these problems, okay? You have to work on these problems by yourself, okay? Put your hands on these problems, okay? So you can pause this video now and start working on these problems, and then resume the video and to see my solutions, okay? So after resume the video, we will go through these problems together, okay? All right. So this is the problem on your textbook. It's on page 329. It's mini exercise 7-6. If you cannot see this easily, you can open your book, okay? So it's exactly the same question, all right? So indicate whether a company interested in minimizing its income taxes should choose the FIFO or LIFO inventory costing method under each of the following circumstances. A, declining costs. B, rising costs. So now let's do A, all right? So if the cost is declining, which means the cost is declining, which means yesterday and today, okay? So that means yesterday's cost was higher than today's cost, right? So what it means is that it's on a per unit basis, or in total, it doesn't really matter. Okay, so as long as the cost you paid yesterday is higher than what you paid today, okay, that means the cost is declining. Okay, so in this scenario, okay, in terms of FIFO method, or LIFO, okay, which one will help us to get a lower income tax, right? So FIFO, that means first in, first out. What it's saying here is that if we're using FIFO, what we purchased yesterday, will be sold before what we purchased today, right? So if we are using FIFO, the unit with $10 cost will be sold before the unit with $5 cost. Okay, then that $10 will become cost of goods sold. Okay, will be $10, and using will be $10. If we're using LIFO method on the opposite side, that means the very later one we purchased, okay, the very later one we purchased will be sold before the one we purchased before, okay, long time ago. Okay, so then the cost of this $5, if we're using LIFO method, will become cost of goods sold. That makes sense? Okay, so no matter which one of these two methods we use, the sales revenue is going to be the same. For example, let's say it's $100. Okay, let's say it's $100 sales. Okay, no matter which one you use, the sales revenue will always be $100. Okay, so now we can see the gross profit for FIFO is gonna be $90. The LIFO method will be $95. You with me? Okay, in that case, holding all other selling and administrative expenses constant, we're going to have a higher income from operations with LIFO method. We're going to have a lower income from operation activities with FIFO method. Okay, so in terms of tax, if we have a higher income, we're going to pay a higher cost, right? If we have a lower income, we'll pay a lower tax. So in this case, if we are in the condition where the cost is declining, and we want to minimize our income tax, then we are going to choose FIFO method. Okay, we are going to choose FIFO method. So that'll be FIFO. And so for rising costs, that scenario, we just put all these things on the opposite, right? On the opposite, on the opposite, on the opposite, on the opposite, on the opposite. And you are going to have a lower tax payment with LIFO method. Okay? If the second scenario doesn't really make sense to you, let me know. I can give you some examples on the discussion board. Okay? All right. Now let's look at a different problem, which also is on page 329. It's mini exercise 7-7, calculating cost of goods available for sale, ending inventory, and sales and cost of goods sold, gross profit, using FIFO method. Okay. Again, if it's not easily to be seen to you, you can work with your textbook. Okay, so July 1st, July 1st, which is our beginning inventory, we carried 50 units. Each one cost $10. So in total, the cost of the beginning balance is $500, right? And on July 13th, we purchased 250 units. Each one cost $13. Okay, I cannot do the math in my mind. Okay, I'll use my calculator. Okay, so that is 3250. Okay, $32.50. All right, and we sold 100 units. Okay, selling price is $15 each, so revenue will be 100 times 15, in total of $1,500 revenue, right? And our ending inventory carries 200 units. Okay, 200 units. So if we are using FIFO method, what we are going to calculate for? Cost of goods available for sale, and ending inventory, and sales, and cost of goods sold, and gross profit. Okay, gross profit. All right. So cost of goods available for sale. Remember, the beginning balance we have. The beginning balance we have 50 units, right? And each cost $10. That's $500. Also, we have purchased 250 units. Each one cost $13, and in total is $32.50. Okay, so in total we have goods available for sale of $300 units. Excuse me. You see, simply being an Asian, or at least Chinese, okay, still I'm not able to do math. Okay, it's not a good example. Okay, don't learn it from me. All right, so in total we have 300 units available for sale, and the cost associated with these 300 units is $500 plus $35.50, which is $37.50. So the cost of goods available for sale is $37.50. Make sense? You with me? All right, now let's look at next one, ending inventory. Oh, ending inventory. Okay, so why don't we hold it until we calculate cost of goods sold? All right, we calculate cost of goods sold. Okay, so cost of goods sold, we have here, we can see we have 200 units left in the ending inventory, right? For me, it's an easier way to calculate all these numbers, and you can definitely work one way around. Okay, you don't have to necessarily follow my steps. Okay, so cost of goods sold, because we are using FIFO method, we sold 100 units. That 100 units has to come out of the beginning balance first. Okay, so we have 50 units from in the units sold that come from the beginning balance, that 50 units. Each one cost $10, right? 50 units times $10, and that's $500. And remember, we in total sold 100 units, and now we only calculate for 50 units. And where do the other 50 units come from, right? Where do the other 50 units come from? Remember, we only have 300 units available for sale, and the other 250 units, it came from the purchase on July 13th. So that 50 units have the other half of sales has to come from the purchase here, because that is the only purchase we made during this month. Okay, so that 50 comes from the purchase here, and each unit cost $13. So in total it's $650. Okay, so we add, so now we have calculated the cost for the total 100 units that are sold. So the cost of goods sold, which is going to be $500 plus $650, which is $1,150. Okay, $1,150. And the trick is here. Now we totally have inventory that cost we totally have inventories that cost $3,750 to sell, and we sold $1,150 of the goods. So there's only two places that our inventory can go, right? Either we sell them, or it will be going to our inventory ending balance, right? So since we already sold that much, the other part of the total cost of inventory have to go into the ending balance. Okay, so now we can calculate ending balance here will be $3,750 minus $1,150. So the ending balance here will be $2,600. Okay, how much is the sales? We calculated here already. Okay, so you can see 100 units times 15, that's total revenue is $15. Okay, so we have $15 of revenue. Okay, so gross profit is the difference between sales and cost of goods sold. So that will be 1,500 minus 1,150, which is $350. All right, $350 will be our gross profit if we use FIFO method. Make sense? All right. So here I will zoom it out a little bit so you can see all these answers here. Okay. Now pause, check your answers to see if you get these things correct or not, and find where you got that wrong. Okay. And you can, whether you can explain it to yourself or not. If not, come back come back to me with some questions. All right, and don't forget to put that into the discussion board, okay, which is a very critical element for our online class from now on. All right, okay, so now that is under FIFO method, right? So now let's erase all these parts. You know, I'm getting old, so everything now I'm doing is taking very slow. So be patient with me, all right? Some of you probably figured it out already that I'm going to do this question with a different inventory calculation method, right? So smart you are. You know, I'm kind of what's the word for that? I have difficulties to tell the difference between colors and colors, okay, especially green and red. But I'm not totally color blind, okay. So what is called it's, I don't know, just lose it. Okay, and now let's look at this. Okay, so all these things, all this information doesn't change. Okay, all this information doesn't change. Okay, we're going to calculate cost of goods sold, ending inventory sales, ending inventory cost of goods sold, gross profit under LIFO method. Okay, LIFO method. Okay, so now you can pause and calculate it using LIFO method. All right, using LIFO method. So cost of goods available for sale, we have 50 units. Each one costs $10. In total is 500. And here we purchased 250, 13 for each, and that is 32.50. Still, we have $37.50 for the cost for the goods available for sale. All right, so doesn't matter which method we use to calculate our inventory, we have physically we have 300 units. No matter which method you use, we're still gonna have 300 units. Okay, and in total we paid that much for those 300 units. Doesn't matter which method you use, we're still gonna have in total that much cost for those 300 units of inventory. Okay, and ending inventory, as again, I'm going to calculate cost of goods sold first and then come back to ending inventory. Okay, so cost of goods sold. Remember, we are now with, we are now with LIFO method, which means last in, first out. Last in, first out. Okay, so still we sold 100 units. We sold 100 units. So that 100 units should come from the most recent purchase, the most recent stock up. Okay, the most recent stock up. Okay, so that means those 100 units should come from these 250 units we most recently purchased. Okay, so then this 100 units come from that 250 units purchased, and each one cost $13. So our cost of goods sold is $1,300. Okay, remember, inventory always going to two places. One is going to customers' hands. It's called cost of goods sold, or it's going to be placed in our ending inventory, sitting in our warehouse, right? So which is reflected in accounting system named as ending inventory. So the total inventory either go to customer hands or go to the ending inventory balance. Okay, so now we have ending inventory under LIFO method for 2,300, no, actually $2,450. Okay, and sales, doesn't matter which method we use, your selling price will hold constant. Okay, simply because you change your inventory method and you're telling your customer that, oh, hey, I'm gonna increase the selling price by $5 or $50. It doesn't make sense. You with me? Okay, so your selling price is $15 each, so your sales revenue is still gonna be $1,500. Okay, all right, and now your sales revenue is 15,000, your cost of goods sold is 13,000, and the difference between sales and cost of goods sold is our gross profit, which is $200 under LIFO method. Okay, under LIFO method. Well, compare this gross profit under with LIFO method to your FIFO method gross profit. See which one gives you a higher gross profit, and you can compare the cost here, and you're starting to see the last question is making sense now. Okay, the previous question is making sense now. All right, okay, Now here is the in-class practice, some kind of check-in. Okay, so I want you to calculate all these things: cost of goods sold. As I said, I'm doing everything here very slow because this really is a wireless monitor. Okay, so it just responds so slow. Okay, make sure that don't mess up too much. All right. Oops. Cost of. Now, what I want you to do is to use weighted average method to calculate first cost of goods available for sale and inventory ending balance and the sales and cost of goods sold and gross profit. Okay, I want you to calculate all these 5 figures using weighted average method. Okay, using weighted average method. Then you post your answers on discussion board in the Fun Place forum. Okay, this one you cannot make an anonymous post. Okay, you have to uncheck that option so that way I can see who posts answers on there. Okay, I can see that. Some of you probably realize that we no longer have participation points, but hey, just you know, this is a very tough period of time going on considering the situations right now. So I really want use every possible ways that I can use to have you engaged in this class and let me know your progress. Okay, so this is I'm gonna use this for your own good, okay, not for me, really. And I appreciate your cooperation. How about that? Okay, all right, so these are the 2 problems for in-class practice. Okay, in-class practice. All right, now let's switch back to our lecture. If you are tired, you can pause the video and go take a break. Okay, play some video games, which I don't really recommend. Okay, you know how time fly when you're on games or YouTube clips, and probably not this one, right? Is this the first video, YouTube video that lasts forever in your from your perspective? I don't know why I'm looking so serious when I'm trying to making some jokes. Okay, probably it's because I'm the only one who is talking to a camera and 3 different monitors and a mic in front of me and different keyboards and materials. Okay, kind of I'm kind of overwhelmed now. All right, anyway, so now let's move back to the lecture. Okay, so now let's talk about the next topic, which is report inventory at the lower of cost or market net realizable value. Okay, so I would read these slides for you first. Okay, so lower of cost or market net realizable value, the value of inventory can fall below its recorded cost for 2 reasons. First, it's easily replaced by identical goods at a lower cost, or second, it's become outdated or damaged. When the value of inventory falls below its recorded costs, the amount recorded for inventory is written down to its lower market or net realizable value. It is known as the lower of cost or market / net realizable value. LCM/NRV rule. Okay, net realizable value or lower of cost or market. Okay, so All right, now let's switch back to the camera. Yes. All right. So I'll take it off. Okay, the cover. Everyone know what this phone is. Okay, you probably know it is an iPhone, right? But what model is this? Okay, think of this. Okay, it is a iPhone 4. Okay, it is an iPhone 4. I bought this iPhone 4 how many years ago? It's in 2011. Okay, since it when it came out, it's almost 9 years ago. Okay, almost 9 years ago. Okay, I paid about $600 for this phone at Best Buy. Okay, at Best Buy, and so here's the thing. I have no idea what the cost of this iPhone 4 is. Okay, so I looked online that some analyst says that it probably take about $180 to make one of this iPhone. Okay, so let's assume that is $100 cost to make one unit of this iPhone 4 cell phone. Okay, $180 to make this iPhone. Okay, from Apple. Okay, but remember, we are talking about retailers business, not manufacturer's business. Okay, so that means Best Buy, before they sell this iPhone to me, they have to purchase this iPhone from Apple, right? From Apple. Okay, so let's assume the cost for Best Buy to get one of these iPhone is $200. Okay, it's just my guess. Okay, it's just my guess. It's not even close to the true cost. Okay, $200, and I paid $600 to Best Buy to purchase this iPhone 4 9 years ago. Okay, so basically at the time when I purchased this, Best Buy made $400 gross profit from my purchase. That makes sense. $600 sales revenue to Best Buy, and it costs $200 for them to get this supply. Then they have $400 gross profit from me, from this purchase. Okay, so why do I explain all this, right? So, well, in general, retailers have a lot of inventory, right? So you're going to Best Buy, you see all these inventories piled up on the shelves. Okay, iPhone, Samsung phone, Google phone, and whatever the thing is on the shelf. Okay, but probably you see just the boxes. It's really not the phones in there. Okay. For some places. Okay, but here's the thing. Okay, which value do you think is higher? The sales price is higher, or the cost in terms of Best Buy itself? Okay, the selling price is higher, or the cost of getting these units higher? Of course, it's the selling price, right? Otherwise, if the selling price is not high enough to cover the cost of the products, then eventually they will no longer be existed on the market, right? So they will end up with some losses, and then they will eventually close the door. Okay, so things like Toys R Us. That makes sense? Okay, so almost always the cost is lower than the selling price. Always the cost is lower than the selling price. However, there are some rare scenarios, rare cases. Okay, so let's say Best Buy was doing their inventory check. Okay, today Best Buy is doing their inventory check today. Okay, really it's not a good time to do this. Okay, given the current circumstances, but just assume. Okay, so they are doing their inventory check today, and surprisingly, one of their staff, their employees, found 100 units of this iPhone 4 in a corner of somewhere in their warehouse. Okay, in their store. Okay, so they found 100 units of this new iPhone 4, which never opened up. Okay, never used, in a corner somewhere in the store of Best Buy. Okay, and do you think you still can sell $600 for each one of these iPhone 4 as of today? No, right? No. I checked online. It's basically cost. I mean, the selling price, well, is around like $60 on average. Okay, somewhere can go higher, somewhere it can be going lower. Okay, so it's not gonna be able to sold for $600. Okay, and let's say it's going to be sold for $100. Okay, I will make it a little bit higher than the average. Okay, $100. However, how much is the cost when we purchase, when Best Buy get these supplies? Remember, $200, right? $200. So we paid $200 for each one of these units, and now we still have 100 units left in our inventory and ready for sale, hopefully. Okay, and now it's only worth $100 on the market. If your set price higher than $100, no one will be willing to pay more than $100 on the market to get one of these iPhone 4. Okay, so in this case, our price is lower than the historical cost of getting these iPhone 4s. That makes sense? The selling price now is lower than the cost of the inventory, right? $100 for the selling price and $200 is the real cost we paid for getting these iPhone 4s, right? So in this case, because we are based off on the conservative accounting principle, that is a general accounting principle. Okay, so now if we still use $200, if we still use $200 to record our inventory, and even though we're not able to sell it for more than $200, in this case we are really over reporting our assets. You see what I'm saying? You are really over report our inventory, our assets. Okay, so that means if we do not adjust our inventory balance, our assets is inflated. Our assets value is inflated, which means that okay, your financial statements is not as accurate as it should be. Okay, so now it is the case where we should use lower of cost or market or net realizable value method to adjust down our cost of those inventories. All right, to adjust down this cost of inventories. Now, how much should we adjust down? We just adjust the cost of these inventories down to the fair market value as of today. Okay, so as of today, it's sellable for $100. Okay, our cost is $200. Then we will adjust the cost of each one of these units down to $100. Okay, we have 100 units. Now the new cost, adjusted cost for each is $100. So in total, our inventory balance for those 100 unit iPhone 4 will be $10,000. No longer $20,000. Excuse me. Okay, no longer is going to be $20,000. It's going to be $10,000. Okay, you understand me? All right. So let's go back to the slides. Okay. All right. Here's the slides. All right. Now let's move on to an example. All right. Here, lower of the cost of market value, net realizable value example. Okay. So this company sells two products. Vintage jeans or leather coats. Okay, cost per item is $20 for each jeans, and it's cost $165 for each leather coat. Okay, value per item. Okay, value per item. Now that's the fair market value. Okay, so how much you can sell one of these products on the market. Okay, so or you can think of this value per item as the selling price on the current market. Okay, so the value per item is $25 for the jeans. Okay, and it's $150 for the coats. All right. So write down per item. If we are following lower of cost or market or net realizable value example, okay, so we can compare the fair market value of now or the selling price of now with the historical cost of the jean of the products, right? So we can see here the selling value, the sellable value for jeans is greater than the cost. Okay, we can sell it for $25 each, but it's only cost $20 each for us, right? So we will be making $5 profit from each one of the jeans we sell. Okay, so that means our fair market value is higher than the cost. Then we don't have to adjust down anything. Okay, we don't need to adjust down anything. Okay, but in terms of the leather coats, it cost us $165 to make one of those coat, but it's only worth $150 on the market, which means you can only sell, no matter what, no matter where the market is, no matter what your customers are. Okay, so you can only sell one you can only sell one coat for $150 at most. Okay, in the best scenario, you can only sell $150 for one coat. All right, but it costs $165 to make one coat, and which means our cost is higher than the value on the market right now. Okay, that means we are not able to cover all the costs of making the coat from sales. All right, so the difference is $15. Okay, $15 for each coat. $15 for each coat. Now, how much we should adjust down our cost, inventory cost for each coat? We need to adjust down the difference between the fair market value and the historical cost, which is $15. Okay, for each unit, we need to adjust $15 down. Okay, so in inventory in our warehouse, we have 1,000 units of leather coats. Okay, so together, each unit adjust down $15. Together, we are going to adjust the $15,000 down for the leather coats in our inventory. All right, so how would we do this? Okay, we adjust this difference into cost of goods sold. Okay, into cost of goods sold. All right, so we will debit cost of goods sold for $15,000 and credit inventory for $15,000. For some of you, probably you are a little bit rusty on the balance sheet or accounting equation or the facts, transaction effects on the accounting equation. So now let's walk through this together. Okay, so we have assets. Remember, is the extended accounting equation: assets plus expense plus dividend equals liability plus common stock plus revenue, right? Everything on the left hand side of the equation will increase balance on the debit side, decrease on the credit side. Okay, and everything on the right hand side of the equation will do the opposite, right? It will increase on the credit side, decrease on the debit side. You with me? So because our inventory cost is inflated, okay, so to speak, we need to adjust the inventory balance down. That means our assets balance will going down. Okay, will be going down. Okay, our assets balance. Our assets balance will going down. Okay, then our assets balance going down on the credit side. So we will credit inventory for how much? For how much? For $1,500. Okay, so for $1,500. Okay, that is the only thing we adjust down. Okay, and how do we make this journal entry balanced? Right, so we have to debit something. All right, I don't know what we debit, but I know it's going to be $15,000. Okay, so in our class, for learning purpose, and let's keep it simple, we adjust it down to cost of goods sold. Okay, so that means the general idea, the concept, logic behind this is that because we are doing this business, the operating activities really is to sell the products, and we are not able to sell the products in a timely manner, and now we are experiencing some losses from the market appreciation from on our products. Okay, so we have to bury the cost. And that cost will go into cost of goods sold. Okay, will go into cost of goods sold. So we will record that into cost of goods sold, which means the cost of doing the business increased by $15,000. Okay, the cost of your operating activities increased by $15,000. Cost of operating activities is expense. Okay, expense increase on the debit side. Okay, so we will debit cost of goods sold for $15,000 and credit inventory for $15,000. You with me? All right. If any questions, again, post on the discussion board. All right. Oops. What is that? Okay. All right. So now let's move on. Okay. Evaluate inventory management by computing and interpreting the inventory turnover ratio. Okay, simply because we are able to, at least I'm able to record this video, and you have the flexibility to watch at any time that you think is convenient for you. And so I want to give you some more information. All right, given our time limit in the face-to-face class, I'm not able to cover everything. So now I have the luxury to give you a little bit more information. Okay, so inventory turnover analysis. Okay, all right, inventory and how it's flowing and those sort of things are very important measures. Okay, so has anybody ever worked as a server in a restaurant, or anyone has a friend who had that kind of experience? All right, so think of that. So you in a restaurant, you would have a certain section of tables, and you would wait on them and provide them their food, and they would give you a tip, right? So if you serve them well, better, and make them comfortable, make them happy, they will tip you a little bit more, right? So, but your tip really is the more tables you serve, the more tips you are going to get. You get that idea? Okay. So what it means is that really when you on the clock, you really want the table turn around faster. It makes sense? You really want the tables turn around faster. Okay. You really want the table turn around faster. Okay. So, it's the similar idea about inventory. Okay, so when you hold up a batch of inventory, you really want to sell them faster, quickly. Okay, as quickly as possible, and then you can purchase another batch and purchase another order and sell it to customers, and then moving on and on and on, right? So this is the inventory cycle. Basically, you purchase it and you sell it, and you purchase it again and you sell it again, and you purchase it one more time and you sell it one more time, and this process is going on and on and on and on forever until the company is closed. All right, so you really want your inventory get turned around faster. That way you rarely will have the scenario where you have to do inventory cost adjustments, which we talked about in the previous slide. That makes sense? Okay, so then there are two measures we can use to measure the inventory turnover. Okay, which first one is inventory turnover ratio, which cost of goods sold divided by average inventory, the number of times inventory turns over during the period. A higher ratio means faster turnover, and days to sale is 365 days over inventory turnover ratio, and that is the average number of days from purchase to sale. Okay, so basically it is the average number of days that your inventory sit in your warehouse. Okay, the average number of days your inventory sit in your warehouse before it's getting sold out. Okay, and a higher number means a longer time to sell. Okay, a higher number means a longer time to sell. Okay, so this is just equations, and if you ever get a problem or questions ask you about inventory turnover ratio or days to sale, don't be panic about I don't remember the equation, the formula. Okay, I'm not asking you to memorize these equations, formulas. It doesn't make sense because you can have access to all these formulas and measures online or in your textbook, even on your phone. Okay, so pull out your phone and open up Google, just tap in inventory turnover ratio. You're gonna have exactly the same formula as we have on the slides. Okay, later on when you use this, you can always get access to these formulas easily. So what I want you to focus on is the concept and how do we explain all these measures. All right, okay. So for example, we have 3 different companies here, and for the fiscal year of 2016, and inventory turnover ratio is 6.3 times for Harley-Davidson, and 31.3 times for McDonald's, and 6.8 times for American Eagle. So that means McDonald's inventory tends faster than the other 2 companies, right? And Harley-Davidson and inventory turns slower than the other 2 business, right? So if we're looking at the days to sell, it takes Harley-Davidson's about 58 days to sell their inventories, and it takes about 6 days to sell McDonald's inventories, and it takes about 53 or about 54 days to sell American Eagle's products, right? So if we're looking at this, simply we can make a conclusion that McDonald's is managing their inventories better than the other 2, right? At least this is what this slide tells us. Okay, so however, when you interpret these inventory ratios or number of days to sale, okay, days to sale, you have to be careful. Okay, the higher the better. It's a general rules, but it also depends on which type of industry you're looking at and which companies you are comparing with. Okay, so if you're comparing McDonald's with Harley-Davidson's, and it's not comparable. It is not comparable because they are selling 2 different types of products. McDonald's selling fast food. Okay, McDonald's selling fast food. Okay, what does fast food means? The food will go out faster, right? So it makes sense they're selling their products faster, right? Harley-Davidson, they are selling motorcycles. Okay, motorcycles. Think about this. How many people really buying McDonald's every day, or at least every week? Probably one day, or 1 meal a week, or 1 meal a day. Okay, and how many people really buying motorcycles on a weekly basis or even on a monthly basis? That makes sense? Okay, so of course McDonald's inventory turnover ratio will be higher, and actually a lot higher than motorcycle industries. All right, so when you are comparing business to business, you have to keep them on the same page. You cannot compare companies from 2 completely different industries. For example, you probably can compare Harley-Davidson's BMW inventory turnover ratios because BMW also sell motorcycles, right? But you cannot really compare motorcycles turnover ratio with McDonald's or Burger King's or Five Guys or pizza, okay, things like that. All right. Also, when you compare your companies, sometimes you need to pay attention to the nature of the companies and the stage that they're in their business cycles. Okay, and if you're a new startup and comparing to 100 years old company, okay, probably you're gonna see difference in terms of these measures. Okay, but you have to explain or interpret these measures with caution. All right. Okay, so that is the chapter 7. Okay, that's the end of chapter 7. All right, so if you have any questions about chapter 7, feel free to post your questions on the discussion board, or you can send me emails about your questions. And if you think this chapter really is the most easiest chapter for you, try to help me to answer some questions on the discussion board. Okay, I will thank you in advance for your help. All right, and don't forget to do your homework, which is going to be due at the end of this week. All right, and also don't forget that is in Eastern time zone. Okay, if you're in different time zones, make sure you are keeping your time with our time zone. All right, and make sure you check your syllabus, class schedules again, and to see which coursework you need to finish by the end of this week. All right, if you do have some emergencies, all right, something unexpected, okay, badly happened, and please let me know as soon as possible. Okay, as soon as possible. In general, I'm not going to give you any excuse for late work due to our circumstances, but really we are moving classes online because of this coronavirus pandemic. So if something is really out of control, I'm still workable. Okay, I'm still workable. But for other regular excuses like, hey, I forgot to do the homework, I'm having a headache, and because I was watching the movie really late last night. Okay, those kind of excuses, just don't waste your time to send those kind of excuses to me. All right, I will not buy them. All right. Okay, and I hope you have a really good rest of your week and enjoy your other classes. Okay, and if you are getting bored, you can post on our discussion board on the fun place, okay, to update what you are doing now in recently, and you can post some pictures there and from your family or from your country if you're already back to your country. All right, so give us some different cultures taste here. All right, I will see you in the next lecture. Bye.